Hey, what's up everyone? Welcome back. Today we are going to talk about something that can literally change the financial trajectory of your entire life. And I mean that without any exaggeration whatsoever. We're talking about hitting an 800 credit score. Now before you roll your eyes and say, yeah, I've heard that before, I want you to understand something. An 800 credit score is not some mythical number that only rich people or financial geniuses can achieve. It is a number that is completely within your reach, no matter where you are starting from today. Whether your score is 580, 640, 700, or 760, every single strategy I'm going to give you in this video applies to you right now. Here is what I know about you. You clicked on this video because something in your financial life is not where you want it to be. Maybe you just got denied for a mortgage. Maybe you got approved for a car loan, but the interest rate was so high it made your stomach drop. Maybe you're just starting to build credit and you have no idea where to begin. Or maybe you've been grinding to improve your score for months and it feels like you're stuck. Wherever you are, this video is for you. In the next, I'm going to walk you through everything. The 5 major credit score factors, the fastest strategies to move the needle, the common mistakes people make that silently destroy their scores, and the advanced moves that separate people with good credit from people with excellent, borderline perfect credit. By the time this video's done, you're going to have a complete, actionable roadmap. Not theory, not fluff, a real plan. Let's get into it. Section 1. Why 800 changes everything. First, let me make sure you understand exactly why an 800 credit score is worth pursuing, because some people think, well, my score is 720, that's pretty good, isn't it? And yes, 720 is decent, but there's a massive difference between decent and excellent. Let me show you what I mean. What the score ranges actually mean. Credit scores in the United States are primarily measured through 2 models, FICO and Vantage Score. Both go from 300 to 850, and both use similar categories. Here's how FICO, the most widely used model, breaks it down. 300 to 579, poor. This is the danger zone. Getting credit is very difficult, and when you do, the terms are usually brutal. 580 to 669, fair. You can get some credit, but you're paying a premium for it. 670 to 739, good. This is where most Americans land. Reasonable rates, decent approvals. 740 to 799, very good. You're getting close to elite territory. Lenders love this range. 800 to 850, exceptional, the top tier. This is where the real privileges live. Now, only about 23% of Americans have a FICO score of 800 or above. That means if you hit 800, you're officially in the top quarter of all consumers in this country. You become the person that every lender, landlord, and financial institution wants to work with. The real dollar difference. Here's where it gets really tangible. Let me give you some real numbers. Say you're buying a $400,000 home with a 30-year fixed mortgage. If your credit score is in the 620 to 639 range, you might be looking at an interest rate around 7.5% in a typical rate environment. Your monthly payment on that loan would be roughly $2,797. Over 30 years, you pay about $607,000 in interest alone. Now, if your credit score is 800 or above, you might qualify for a rate closer to 6.5%. Your monthly payment drops to about $2,528, and your total interest paid over 30 years around $510,000. That's a difference of nearly $100,000 just from having a better credit score. That's not a small number. That's a down payment on another house. And it doesn't stop at mortgages. Think about car loans, personal loans, credit card APRs, even your insurance premiums. Yes, in most states, your credit score affects what you pay for car insurance and homeowners insurance. A better score means lower premiums, month after month, year after year. People with 800-plus credit scores also get access to the best rewards credit cards, the ones with the biggest sign-up bonuses, the highest cashback rates, the best travel perks. They get approved instantly. They get the highest credit limits. They have leverage in financial negotiations that people with average scores simply don't have. And here's something no one talks about enough. Having an excellent credit score changes how you move through life financially. When you have a score of 800, you stop worrying about whether you'll get approved. You stop accepting bad loan terms because you feel like you have no choice. You stop avoiding financial conversations out of embarrassment or fear. You walk in with confidence, and that confidence has compounding returns that go way beyond the dollars and cents. Okay, now that you know exactly why we're doing this, let's talk about how. Section 2. The 5 factors. What your score is made of. Before you can improve your score, you need to understand what is actually being measured. Your FICO score is calculated using 5 specific factors, each weighted differently. If you don't understand these factors, you're essentially trying to hit a target you can't see. Factor number 1. Payment history, 35%. This is the single biggest factor in your credit score, and it's also the most logical one. Do you pay your bills on time? That's what lenders care about most. If you have a history of paying on time every single month without fail, that tells a lender you're reliable. If you've missed payments in your past, collections, bankruptcies, or charge-offs, that screams risk. A single missed payment, just 30 days late, can drop your score by 50 to 110 points depending on where you are starting from. If your score is high to begin with, one missed payment hits you even harder because you have more to lose. The good news, if you have missed payments in your past, they do lose power over time. A missed payment from 5 years ago does much less damage than one from 6 months ago, and after 7 years, most negative items fall off your report entirely. The action item here is simple but non-negotiable. Set up autopay for every account. Every single one. We'll go deep on this later in the video, but never let a bill be late again, ever. Factor number 2. Credit utilization, 30%. This is the most misunderstood factor, and for many people, the fastest lever you can pull to improve your score quickly. Credit utilization is the ratio of how much revolving credit you're using compared to how much you have available. So if you have a credit card with a $10,000 limit and you have a $3,000 balance on it, your utilization on that card is 30%. FICO looks at your utilization both per card and across all your cards combined. Here's the rule that most people get wrong. There's a common belief that you should keep utilization under 30%. That's actually a pretty mediocre target. People with 800-plus credit scores typically maintain utilization under 10%, and many of the highest scores keep it under 5%. Think about that. If you have $20,000 in total credit limits, keeping a balance under $2,000, ideally under $1,000, is what actually gets you to $800. Another critical thing to understand, credit card balances are reported to the bureaus on your statement closing date, not your payment due date. So even if you pay your card off in full every month, if you have a high balance on your statement date, that's what gets reported. We'll talk about how to manage this strategically. Factor number 3, length of credit history, 15%. This one is more about patience than action, but it matters. FICO looks at 3 things under this category. 1, how long your oldest account has been open. 2, how long your newest account has been open. 3, the average age of all your accounts. The older your average account age, the better. This is why financial experts often say never close your oldest credit card even if you don't use it anymore. That card is an anchor for your credit history. Closing it removes that history from your average age calculation and can ding your score. It also means that opening a lot of new accounts very quickly is a problem, not just because of the hard inquiries, more on that in a second, but because new accounts lower your average age. If you're just starting out, time is your ally. Open accounts responsibly, keep them open, and let the age work in your favor. If you've been building credit for a while, protect your older accounts carefully. Factor number 4, credit mix, 10%. Lenders like to see that you can manage different types of debt responsibly. There are 2 main categories. Revolving credit, things like credit cards, home equity lines of credit, and personal lines of credit. These have flexible balances that you can carry and pay down. Installment credit, things like mortgages, car loans, student loans, and personal loans. These have fixed payment amounts over a set period of time. Having both types in your credit profile shows lenders that you're a well-rounded borrower. You don't need to rush out and open new accounts just for the sake of credit mix. That could backfire. But if you only have one type of credit, it's worth thinking about how you might add the other responsibly over time. Factor number 5, new credit, 10%. Every time you apply for a new credit card or loan, the lender typically does a hard inquiry on your credit report. This temporarily lowers your score, usually by about 5 to 10 points, and stays on your report for 2 years, though its impact fades significantly after the first year. The concern here is not one inquiry, it's a cluster of them. If you apply for 5 credit cards in 1 month, lenders see that as a red flag. It can look like you're desperate for credit or that something in your financial life is going wrong. For rate shopping on a mortgage or car loan, which requires multiple lenders pulling your credit, FICO has a built-in protection.